All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's office hours check-in for Thursday, April 13th, 2023. So the only question that I saw was this one. I want to try to get this done in about 15 minutes, so I have time to get the daily reports out, but I think I can do it. Let's see. So the question was about trying to get an understanding of the river around the MACD on the bottom of the charts. I'm going to show an example here in a minute. So this is the larger idea. I have something like a tactical display, and then deeper trends. So tactics change quite a bit. There's a lot of activity going on inside there. And the trends what we're looking for is slower, easier moves. Well, when we're looking at the trends, we're looking at price and the moving averages of the 10 and the 30. So we're looking at the RL10 and the RL30. So this price tends to be the noisiest. And then the RL10 is a smoothed price. And the RL30 is the health of the trend. So in the RL30, we're really concerned about not just location, but also the direction and the slope of the line. So if we had let's say we had some sideways price action and price was all tightly clustered, then the RL10, which we draw in blue, would be very tightly wired with the price. And the RL30 would have come down and joined it very soon after, RL30. Okay. The first thing that happens, and let's just, for the sake of argument, let's just say that we had a really tight pinch in the Bollinger Bands too. So maybe that's the Z3 line. So everything is tightly clustered together. So the first thing that's going to happen is that the price is going to depart and start heading down. And then the RL10 has a little tiny bit of a lag, but pretty quickly comes and joins the price. And then the RL30, because that is slower to move, is going to create some kind of lag, but it's eventually going to come down like this as well. So one of the things that we can notice is, in general, what is the distance when we slice this vertically with each bar, right? What we care about is the difference, between the RL30 and the RL10. So if we detrended that, we would just get some kind of, that's how much stronger the shorter term trend is in terms of moving downward. If that starts getting larger, that distance between those, then we know that the trend is increasing, that downward trend is increasing, and it's getting stronger. But a lot of times that RL10 is gonna monkey around like this, and so it'll go in and out of fit, and the RL30 won't change that much because those little changes in the RL10 are not enough to really make the RL30 move. And so that's why we say the RL30 is the health of the trend, and it's very smooth. And when it turns, that turns out to be really significant from whatever the bottom of it was. That's where we start getting owl entries after everything reverses. But what we're interested in right now with the MACD is to try to smooth out some of those noisy price changes. So up here where price is in the top half of our charts, we're looking at price action is moving and moving and moving and moving, and then the RL10 is wiggling, and then the RL30 is slowly changing. And when the RL10 and the price can't go any lower, and then they start to cross back up, they reverse sooner than the RL30, which takes a little bit longer before it turns. So what we care about is that little RLXD when the RL10 crosses. So there was a time when they were co-located here, and then it started to pull away, and then there's a time when the RL10 moves up and it closes. So I like to think of this as the window of opportunity. This is where the opportunity to make money was, as the RL10 was pulling away from the 30. Well, what we care about longer term is just how big of a move was that. If we went from the peak to the trough, how big was that move? How significant? How fast did it pull away? And a lot of times, price and the RL10 are so jumpy that you can get lost in the noise. So now what we're going to do is we're going to smooth that out and simplify and just study the long-term trends, the smoother trends, by looking at the MACD histogram at the bottom of the chart. And so when we think about the MACD histogram, we know it's a lagging indicator, but it does an interesting job of finding turning points. So the way we interpret that is that the zero line occurs when we look at the 10, we're going to compare the 10 period against the 30 period moving regression line, and we're going to take the difference between those two and make a 5-period smoothing average of it. So when I see the signal line, I'm going to draw it as black, that tends to be very smooth and then makes an orderly reversal. And it is typical to see that. And so when you look up at the tactical screen, you see a lot of things jumping around. But if you look at the bottom, everything is very smooth. And here's why. It's taking the 10 period minus the 30 period, and that gives you some value. And then it's taken the last 5 values of each of the last time frames, and then taking a 5-period moving average. And then that's what that smoothed number is. And then what it's going to do is we're going to also take a 5-period average of that signal line, and then that's going to be our smooth constant. So when we interpret this, those little changes in the direction of the signal line turn out to be significant. So we think of this as the 4 seasons. When it crosses below the zero line and the slope is down, we're in the winter. And in the winter of MACD, we basically want to be short. We don't want to be taking longs. If we were to look at this period and look straight up, we would notice that in general, price is moving down sharply. And then there will come a period of time when it smooths out. And when it smooths out, you get this kind of feature where the RL10 and the RL30 come closer together because its price is no longer failing. It's starting to just go sideways. So the 10 starts smoothing out, but the 30 keeps pinching downward. And so what you get is that the difference between those two, the calculation is based on the RL10 and not on price, right? So it's comparing 2 moving averages, but instead of simple moving averages, we're using our faster and more adaptive regression lines. So it turns out that the things that we're seeing on the MACD are unique to us. Like nobody else in the world is looking at the difference between moving regression lines. They're looking at simple moving averages, which are slower. The RL10s and 30s are faster to adapt to turning points in the trend. So we actually get an earlier signal when the winter stops and the spring begins. So it's winter as long as the signal line is moving down, but when it reverses and starts moving up, but it's still below the zero line, we are now in the spring. And in the spring, price has improved enough that we can start making careful ventures on the long side because the pain and suffering has stopped. It's no longer failing. It's actually making a turning point. So we do that in the spring until it gets back to the zero line. And when that signal line keeps going up, we're now in the summer. And in the summer of MACD, we want to be, that's our growing season. And we want to watch that until it starts to roll over and becomes the fall. And in the fall, we want to be harvesting. You want to harvest in the fall. You don't want to stay around too long. You got to harvest before it goes back into the zero, below the zero line, into the winter. But sometimes we get a summer, fall, and instead of failing, it reverses and goes higher. So a summer, fall, and summer is a very strong signal to get long again or to add a second position. As long as that is above, remember, if it's in the fall and goes right back into the summer, it's still above the zero line. The zero line is down here. You know, that's when it went into the summer. So as long as it makes that summer, fall, and then back into summer, that's a signal to instantly to re-enter or to add a second position. By the same token, if we also see a winter and it gets better and starts going into the spring, but then it can't get to the zero line and it rolls over and goes back into the winter, that is an instant short. So the winter, spring, winter pattern is an instant short. That's like a collapsing dragon. And by the same token, on the upside, a summer, fall, summer is an instant long. That's a signal to go long. All right, so that's in general how we think about the four seasons. So what the four seasons of MACD do for us on the bottom half of our chart is to give us a seasonal approach to like a growing season as a farmer, and it gives us a general bias or orientation about what signals to be looking for on the tactical screen in order to maximize our alignment with the deeper, slower moving trends. Check or hold?
Ken, quick question for you.
All right, so let's see what I want to do. Let me go to see if we can't clean this up a little bit. Now, there's one more phenomenon on here, and that is we can learn to fine-tune our understanding of this whole process. And that is the actual question he asked me was about the Red River. Oh, I didn't have my ears on. Who had a question?
Yes, I do.
So the Red River, I wanted to get to that now if I can. Is that what your question is?
No, I have just a quick follow-up on this 10, 30, and 5 that you have written right below.
The 10, 30, and 5.
Okay, so that is just to completely clear about it. It's all three numbers are on RL10. The first is a 10-day.
This is it's the first. This is moving average number 1
on RL10.
So when it's the parameters we have is the 10, but we're using the RL10
right
as the moving average. And then this one means it's looking for the RL30. So you have to go in and choose that as the. You have to choose that as the
the minus
parameter. Instead of if you go to regular MACD, it'll use a simple moving average of something, and a
something
simple moving average of something. And
of the
this
same
one,
thing,
uh,
in fact.
yes, yes. And sometimes they use price,
Right.
but we're using the RL10 value and the RL30 value as the fast and the slow. And then we're taking
Perfect.
then it compares the difference between those two, and we use a 5-period smooth to give you
Perfect.
this very smooth and
And
orderly
right.
roll.
And that 5 period is just simply an arithmetic average of RL10 minus RL30 that we have done here.
Correct. That's correct.
Okay.
So in TC2000 and TradingView and Thinkorswim, you can substitute different data sources
Right.
for the indicators to compute on. So this gives us a bit of an edge, as I described. Now, the last thing that I want to talk about is the Red River. So when we're looking at the tactical price, we have a Bollinger Band 30, 1, and that gives us the river for the tactical. That's sort of the normal crocodile river where you get chewed up. We don't really want to take signals when price is inside the river. We want to let it get to an extreme. Well, how do we know, when it's sideways and it's in that 30 period? Let me draw the river. So when the river is here and price is really tightly compressed and it has a breakout and then starts to reverse, was that a big enough move to be significant? So how do we interpret? So one of the ways we can do that is coming down to look at the MACD histogram, and we want to see how far this thing went into the winter. Was it a significant move into the winter? Okay, so here's how we're going to do that. We're going to set up the 0 line, and then we're going to compute the signal line, and it's going to go like this, and then it's going to go up, and it's going to come down, and it's going to come down again, right? Let me go back here. Now, how far was this move into the winter when it made the turn? Well, one of the ways we can do is we can say, what was the extreme level that it got to, and how fast did it get there? So what we're going to do is we're going to put a Bollinger Band on the MACD signal line itself. And what we're going to do is we're just going to put a 30 period plus or minus 1 on the MACD signal line itself. Okay? Now, what will happen is when we look up at the tactical screen and then we come down and look at the MACD screen, if price had some extreme move very fast, it went very far down and it did it very fast, we would say, oh, that is an extreme move. When we get a significant extreme move like that, it'll show up on the MACD as one where the red river is the 30 period Bollinger Band around the MACD signal line. And when the signal line leaves its own river, then that means the difference between the RL10 and the 30 was so extreme that thing is accelerating abnormally. And then we can see now that when the MACD signal line leaves the red river, that is now a significant change of trend, and it's raging to the downside. But when it leaves the winter and turns into the spring, what happens is it makes a pretty sharp turning move, and it starts going back up. And one of the things that we can use the Red River for is to determine, I look at 3 points. I say, once it makes an extreme move out of the Red River, I know that the MACD excursion was significant, and I know without even looking that the tactical screen would show an enormously large downward move. But then I know that when the MACD signal line turns from the winter and goes into the spring, it enters the Red River, it crosses the spine, and it leaves the Red River. And the Red River is much slower to turn and it will come up here to catch. So now there are certain magical points on this one. Whenever this MACD goes below the zero line and becomes winter, that's important. When it leaves the Red River, that's important because now you know that the trends themselves have started to really change and become sharply down. Then when winter turns to spring, after an extreme winter, you know that you have the potential for a really nice upward move. And the way you can time that is looking for when it turns and becomes spring, when it enters the Red River, crosses the spine, leaves the Red River. Now what you have is a really strong reversal, and you still have room for it to get to the zero line. That's when I want to make sure that by this time in the spring that I have started my swing long. Then if that works, it will, when it crosses the zero line, now I know I've already got a good position on, and now I can begin to enjoy the summer until it reverses. Now, if this is a really strong summer move, it will have left the Red River behind until this peaks, and then as long as this stays north of the Red River, it can be in the fall. But when this comes into the Red River, that's about where I need to be exiting my excellent long positions. And then I look to see, is it going to go below the zero line and go into the winter? If it does, I want to be short. But if the fall turns somewhere in this inside the Red River, if the fall turns back into summer, that is where I want to make my re-entry. So what the Red River does is it creates the sense of normality of the MACD signal line, and now you get alerted when there are exceptional moves. Now, how can I use that? I can use it on a trade that I'm actually trading, and I'm trying to be short in the winter and long in the summer. But also, if I'm looking at a big long, and this is where it really pays off, if I am looking to make to buy deeply out of favor targets, I can have a great big stack of symbols, and I can see which ones have the furthest winter away from the Red River. So I can take a z-score of the MACD compared to the Red River. So if I take a simple z-score like this, I'm going to make it with the Red River. If on a given time frame, that's the Red River, the very middle of the Red River has a zero z-score. You guys clear on that one? Yeah. And then the top of the Red River has a z-score of 1, and the bottom of the Red River has a z-score of -1. So if I have 500 symbols in the S&P 500 or 200 symbols in the ETFs, what I can do is I can simply look to see what is the z-score of the MACD signal line compared to the Red River. And the one that has the worst z-score is the one that had the absolute horriblest, worst winter ever. And when it makes a turn and starts moving up, and the winter now turns to spring, and it has that enormous z-score, I know that the harshest winter in recorded history is over, and maybe it's ready for a nice long recovery. So I can actually use this when the whole world market model, like in COVID, everything got smashed and everything was in the winter of MACD. I could see the ones that had the worst sell-offs and which ones had the quickest turnaround. Sometimes I'm interested in the ones that had the deepest winter because that's the best value play back to the zero line. But I could also be interested in the ones that had the best z-score because they suffered the least. And it turned out that those were the ones that gave us the best leadership coming out of COVID. And within about 2 weeks of the worst COVID sell-off, we were already starting to buy positions, and we got something like a 75% gain on things that just didn't sell off as much in the COVID. So by looking at the Red River, you don't even worry about tactical price at all. You're simply looking at the relative strength of two different trends, the 10 period and the 30 period. And then the Red River helps you discover what are the extremes of bad and the extremes of good. So that's the general idea. Now, here was the example that was provided. Let me find the example, and I'll show you how that works. Yeah. So here is a trade. This happened to be an intraday trade in coin, but this could have been weekly charts or 9-day bars, anything, doesn't matter. So this whole trend started off up, it closed here and it gapped up. So that's initially good. Look at how that pulled the signal line above the Red River. This was actually potentially very good because it was leaving all of this behind and the trend was pulling up. But it couldn't sustain that. And so it crashed through the VWAP. It crashed through the dragon on the top shelf. It broke the PSAR flip. And this led to one leg down, pause, a second leg down, pause. And you say, how bad was this first leg down? I can just come down here and say, oh, awesome. This is where the signal line left the Red River. That's telling you that this was a painfully large, sharp downward move. And that means there could be more coming. Now, we already knew that because here's the collapsing dragon. So this thing is already becoming horrible. That means even after a period of sideways consolidation, the fact that this was so bad means that I'm ready for it to collapse again. And now I can really get this second leg down. Okay. So I'm not surprised when there's another big leg down. The fact that it came out of the Red River down here tells you that there's more pain and suffering. Now I want you to notice we're going to see the winter, spring, winter pattern. So it's below the zero line, right? So anytime that signal line is below the zero line, I have a short side bias. So here it is, it's leaving the Red River, and now it becomes winter. It's trying to get into the spring. It's slowly getting into the spring, but it cannot even get to the zero line at all, right? It has to get up into here, but it couldn't. Right here, it started getting bad, and that was enough to tell you, instead of this thing going into the summer, it became winter again. And by this time, it left the Red River. So you still had this much room. You had this much early warning that this thing was horrible. And now it got into the spring outside the Red River. It tells you that this whole move was exceptionally painful, which means that it might have been so exaggerated that it alerts the value players to come in and start getting some buying pressure. And buying pressure is what happens here. Now look at what happens with the signal line compared to the Red River. Enters, crosses, departs. That means this is a strong enough summer to buy it. And now look, he got the perfect entry here because this was enough of a turning point after a horrible winter that it creates a really nice move back to the VWAP. So he gets the VWAP trade, and now it's in the summer, and now he can go summer, fall, summer. So he gets summer, fall. He can buy this again with a deep stop, and he still gets this whole move until the winter, until the fall comes here, and now it comes out. That tells you that the upward run is done, and now you got to be worried about the downside. And here's where it crosses the zero line. Look at that. This tells you that the short right here is good because it crossed below the zero line, and now you get the whole winter. You get winter, spring, winter. You could stay in that whole trend from here to there. So that's a way to use the smooth trends of MACD to help you understand where are the key turning points after extreme moves. You want to know that this was not just a downward move, it was an extremely downward move as measured by the fact that it came out of the Red River twice. And then when it goes back into the Red River, that run is over. And when it leaves the Red River, you're ready for a big upward move, which is from here all the way to here and from here to here. Notice how it tells you what the exceptional moves are. The edge of the Red River defines that boundary of normal. So this is an extra way, especially when it comes out here. This tells you when it's time to really have a change in bias or that an exceptional move is just getting ready to start. All right, so that's how we read the MACD histogram. And that's what the Red River does for us. It gives us what is the difference between normal and abnormal trends in the MACD, which gives us insight into normal and abnormal moves in the price screen. So this is exceptionally good for swing trading because you can get those big, long, horrible winters, and it's a long way back to the RL 270. And you say, how good does it have to be before I can start buying it? You can come down here and look at the MACD histogram and the seasonality and where is it with the Red River. When it comes out of the Red River, you better be long. And this is massively, massively good for your longer term moves that are not, so you don't want to get chased out by daily prices so much. So in the long-term conservative, this protects you against the big sell-off. When it goes below the zero line, your long-term positions are out. But after it leaves the Red River and then crosses the Red River in the spring, that's planting season, and you can stay in all the way to the fall. Check or hold. That is so much. That is worth so much money, guys. I'm telling you, that is money. The long-term money managers that I work with, the pension fund guys and the registered investment advisors, they have to stay in positions longer. So they need to find when the big turning points are in the large, longer-term markets. They got to get that right. They don't have to be precise on the tactical pieces. But here's the beauty of this thing. No matter what time frame you're working on, whether this is 1-minute charts, this relationship between tactical prices and smoother long-term, this is a fractal relationship. And whether you're using 1-minute charts or 9-day bars, the relationship between the prices and the moving averages is interpreted exactly the same way. And so on the 3-day and the 9-day bars, oh my God, this is money in the bank. All right. So that's everything I want to cover. I need to get about 15 minutes to get the reports finished up, but I'll get this published and posted and hung in the foundations course for you for later study. And then that gives you more things to kind of look at, in the nightly and see what's going on. Okay. So thanks for your great question and for hanging in there.